Hello and thank you for watching. I am Kevin Demerit, and Wilshire Finance Partners is a professional private money mortgage banking company. This video was created to help compare trust deed investments to other popular investment choices. In this case, we are going to examine the basic differences between stock and trust deed investments. So let's begin with stocks. When evaluating a stock, most due diligence is placed on the company's product, its sales growth, how fast it's growing, its earnings per share, how much money is it making, management efficiency, and liabilities, how much it owes others. Less emphasis in stock investing is placed on collateral or the assets in back of the stock. On the other hand, when evaluating a good trust deed, most of the emphasis is placed in three main areas. First is the borrower, their payment history. Do they like to repay their loans? Secondly is the cash flow or potential cash flow of the property. Can this property that we are going to lend on or have lent on stand on its own as an investment by itself? And third, and most important, is the value of the property that is backing the loan or your collateral. This is the most important factor when investing in trust deeds because your collateral is used to protect your principal. So we want to make sure that we have strong collateral. In trust deeds, less emphasis is placed on liquidity because trust deeds are typically held to their maturity and they generate a monthly cash flow to the investor throughout that maturity period or throughout that loan period. But the main difference between stocks and trust deeds, as far as collateral is concerned, is what we call accessible collateral. Where is your stock's collateral? With stock, you have no direct collateral securing your interest, and the collateral behind a stock is typically not easily accessible. But Wilshire trust deeds are located in California real estate that can be inspected, real estate that can be appraised, and real estate that can be readily foreclosed upon if it comes to that. So now let's take a look at some of the other differences. Let's examine the 7 most common considerations when investing. A first consideration is probably commissions or load fees. Well, with Wilshire, there are no load fees or commissions paid when purchasing a Wilshire trust deed. Stocks obviously carry some form of commissions and/or buy-sell spreads or both. Another consideration is liquidity. Trust deeds are usually held to their maturity. Currently, our typical maturity is 12 to 24 months at Wilshire. A stock, on the other hand, can be liquidated extremely quick on a daily basis on the exchange. So much more liquidity on a stock. Third is expected returns. Stocks can fluctuate by the hour and the minute, so their return is variable. But no matter what stocks do, no matter if they are up or down, a trust deed's monthly interest is usually fixed. Another consideration is volatility. Because of the nature of trust deeds, volatility is usually low. However, investing in stocks can be like trying to nail down Jell-O. On any given day or week, a stock can be both up and down. Another factor is tax protection. Both stocks and Wilshire trust deeds can be held in an IRA or other types of retirement accounts for the tax benefits. Position is another consideration. As a stockholder, you are typically in a third position behind preferred shareholders and bondholders. But Wilshire trust deed owners are always in a first lien position. And lastly is protective equity. Protective equity is the safety cushion or difference between your invested principal and the market price of the asset backing your investment. Wilshire trust deeds typically have at least a 35% equity cushion between your invested principal and the asset backing your investment. A Wilshire trust deed loan is originated below the property or collateral value. It's secured by real estate with a value greater than the mortgage placed on it. A stock is typically sold above its book value. So let's look at a protective equity chart examining stocks and trust deeds. Typically, most stocks do not offer protective equity positions to investors. Any amount invested in a stock is usually immediately at risk of market fluctuations because you typically have purchased the stock on the exchange at its full market value. Wilshire trust deeds typically offer a minimum of 35% protective equity cushion to our investors when we originate the loan, meaning the loan on the property is typically no more than 65% of the property's value. That means, without including foreclosure or other fees, a Wilshire trust deed investment and the property's value could decline by approximately 35% before your principal is at risk. Wouldn't it be nice if stocks could fluctuate 10, 15, or even 20% and you could still get your original investment back? So let's take a quick look at returns for stocks and a typical trust deed over this past decade. As you can see, $100,000 invested in the Dow Jones from January 1st, 2000 to December 31st, 2010 generated a total increase of $6,400. $100,000 invested in trust deeds in that same time period generated $143,333 in profit. That difference totals a whopping $136,000, or 21 times more profit this past decade than stocks. We hope this information helps explain some of the basic differences between stock and trust deed investing. This is not information that should be used to choose one investment over the other. Rather, we hope it helps in examining the options for diversifying your portfolio. If you would like to learn more about trust deed investing or Wilshire Finance Partners, please feel free to visit our website at wilshirefp.com or call our offices at 1-866-575-5070. Thank you for your time.